and welcome to our channel. Today, we're going to be discussing the differences between credit reports and credit scores. Understanding these differences is crucial for managing your finances and making informed decisions about borrowing money. First, let's define what we're talking about. A credit report is a detailed record of your credit history, including information about your borrowing and repayment activity. This includes things like credit card accounts, loans, and other forms of credit that you have taken out. A credit score, on the other hand, is a numerical representation of your credit worthiness. It is calculated based on information in your credit report and is used by lenders to determine your risk level as a borrower. Now that we have a basic understanding of what these terms mean, let's delve into some of the key differences between credit reports and credit scores. One of the main differences is that credit reports and credit scores are generated by different organizations. Credit reports are compiled by credit bureaus, which are companies that collect and maintain credit information about consumers. Credit scores, on the other hand, are calculated by credit scoring companies, which use the information in credit reports to generate a numerical score. Another key difference is that credit reports and credit scores contain different types of information. Credit reports include detailed information about your credit accounts, such as the type of credit, the credit limit, and the balance owing. They also include information about your payment history, such as whether you have made your payments on time and in full. Credit scores, on the other hand, do not contain this level of detail. Instead, they provide a summary of your credit worthiness based on a variety of factors, including your payment history, the amount of debt you have, and the length of your credit history. A third difference is that credit reports and credit scores are used for different purposes. Credit reports are primarily used by lenders to evaluate your credit worthiness when you apply for credit. They may be used by landlords, insurers, and other organizations to assess your financial risk. Credit scores, on the other hand, are used by lenders to make decisions about whether to approve your application for credit and, if so, at what terms. Finally, credit reports and credit scores are subject to different laws and regulations. Credit reports are governed by the Fair Credit Reporting Act, which sets out rules for how credit bureaus must collect, maintain, and use credit information. Credit scores, on the other hand, are not subject to the same level of regulation, although they are still governed by consumer protection laws. So, to summarize the main differences between credit reports and credit scores, credit reports are compiled by credit bureaus and contain detailed information about your credit history, including information about your credit accounts and payment history. Credit scores are calculated by credit scoring companies and provide a summary of your credit worthiness based on a variety of factors. Credit reports are used by lenders and other organizations to evaluate your credit worthiness, while credit scores are used by lenders to make decisions about whether to approve your application for credit and, if so, at what terms. Credit reports are subject to the Fair Credit Reporting Act, while credit scores are subject to consumer protection laws, but not at the same level of regulation. We hope this has helped clarify the differences between credit reports and credit scores. Understanding these differences is an important part of managing your finances and making informed decisions about borrowing money. In addition to understanding the differences between credit reports and credit scores, it's also important to know some key facts about credit worthiness. One important fact to understand is that your credit worthiness is based on a variety of factors, not just your credit score. In addition to your payment history and the amount of debt you have, lenders may also consider your income, employment status, and other financial information when evaluating your credit worthiness. Another important fact is that your credit worthiness can change over time. As you borrow and repay credit, your credit report and credit score will be updated to reflect your activity. This means that if you consistently make your payments on time and keep your debt levels low, your credit worthiness will likely improve. On the other hand, if you miss payments or take on too much debt, your credit worthiness may decline. It's also worth noting that credit scores are not static and can change from one day to the next. This is because credit scores are based on the information in your credit report, and that information is constantly being updated as new credit accounts are opened and closed and payments are made. As a result, it's important to monitor your credit score regularly to ensure that it is accurate and up to date. Another key fact about creditworthiness is that it can have a significant impact on your financial life. Your creditworthiness can affect your ability to borrow money, as well as the terms and rates you are offered on loans and credit cards. It can also impact your ability to rent an apartment or get insurance, as some landlords and insurers may use credit scores to evaluate applicants. It's also important to be aware of the potential consequences of poor credit. If you have poor credit, you may be denied credit altogether or offered credit on unfavorable terms. This can make it more difficult and expensive to borrow money, which can have a ripple effect on your financial situation. Finally, it's important to understand that there are steps you can take to improve your creditworthiness. Some strategies include paying your bills on time, keeping your debt levels low, and monitoring your credit reports and scores regularly to ensure that they are accurate. By taking these steps, you can work to improve your creditworthiness and build a strong financial foundation for the future. In conclusion, understanding the facts about creditworthiness is crucial for managing your finances and making informed decisions about borrowing money. By understanding the factors that go into determining your creditworthiness, as well as the potential consequences of poor credit, you can take steps to improve your creditworthiness and secure a strong financial future. Thanks for watching. If you have any questions or would like to learn more about credit reports and credit scores, please leave a comment below. I'm signing out, baby.